Meanwhile, Kenya's central bank governor Patrick Njoroge says a new banking law capping interest rates at 4% above the central bank rate may have slowed down credit to the private sector. Njoroge revealed that private sector credit growth had declined 2.1% in the country, adding that the legislation had complicated monetary policy. Well, to find out just how much this new law has interfered with the Apex Bank's policies, I spoke with Jibran Qureishi, an economist in charge of East Africa at Stanbic Bank.
The interest rate law that was imposed last year in September has brought about a lot of complications with monetary policy, transmission, perhaps even conduct. I think when you look at the fact that rates are capped at 14%, as you mentioned, if we were to see the central bank rate cut today, we would see the cap come down. I think that would actually be counterintuitive, would actually see credit growth slow down even further. The reason I say this is at 14%, banks are already quite limited in the appetite, the risk appetite that they're willing to take. And I think if you bring the cap lower to 13 or 12%, the pool of eligible borrowers that banks are willing to lend to will actually shrink even further. So that's why I think, the interest rate law has been detrimental. SMEs have suffered quite a bit. Banks have rationed credit, understandably so. But I think it's also brought about a lot of confusion with monetary policy, given that a cut is now a hike, and a hike will actually be a cut.
And going forward, what do you expect? I mean, you mentioned it was detrimental, and the CBK governor has said this himself. He's pushing the case for a review as well. What are your expectations?
I think there's a growing consensus that in some form or another, the cap's going to be reviewed. In our view, I think it's paramount that the cap's reviewed and not just the floor, because if you look at banking activity, if you look at monetary aggregates, commercial banks have understandably again, shifted all their deposits from, savings deposits to demand deposits. So I don't think cost of funds is a problem. I think it's a risk appetite with the cap. But again, there is a growing consensus. Politically, it's probably only going to be possible after elections. It also depends on what government's going to be in place and whether it's going to be a priority for them. But there's enough economic data to prove that the cap hasn't worked as we all expected. And I think it's high time that we rethink about those reforms.
Now, looking at the overall macroeconomic picture, demand down, like you mentioned, domestic demand down, private sector credit growth weak as well, GDP coming down as well. What is your outlook, and how do you think this is going to impact the MPC decision as well going forward?
If we are on the same page as the central bank or the Monetary Policy Committee, and they're saying to themselves that, in an environment where rates are capped, how much can we really do? I'm not sure that they'd be willing to react now, given that we have this environment with the law.
Correct.
I think there'll be more clarity around the next move once there's some reform or revision around the cap. But when you look at growth, it's going to be lower this year. It's not just a slowdown in private sector credit growth. It's also given that we are an agrarian economy, and of course agriculture accounts for about 30% of nominal GDP. Agriculture production has underperformed due to the drought, and of course towards the back end of 2017 there's a risk of production falling even further because of the invasion of armyworms. So I think all these factors, the confluence of all these factors, is actually going to keep GDP suppressed. I think it's going to come in at 5.2% for 2017. Given our potential in Kenya, it's way below where we want to be. But given the sub-Saharan African average of 2.5%, we're actually performing quite well.